Hey, Jason here. Today's video, we're going to do the full preliminary analysis of Perdoceo stock, Perdoceo education, stock ticker PRDO. This is a continuation. This is part 2. You can see part 1 in the description below, where we did a visual preliminary analysis look of Perdoceo. Today, we get to stage 2 of my analysis process, where we do the full analysis worksheet, which you see on the right of your screen. Before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe and hit the notification bell so you're notified every time we release a video, and release videos all the time. Okay, again, I don't want to do this. I have to do this because every time I don't, I get nasty comments. But on these videos, if you haven't seen one of these videos yet, shorter disclaimer, but this is still for your informational purposes only. Do your own research, do your own due diligence. This is based on my personal biases, my personal strict criteria, what I look for in investments. But this is for your informational purposes to help you learn how to better and faster evaluate stocks. However, again, do your own research, do your own due diligence. Okay, so let me get my face out of here, so we can look at Morningstar. Let me check. Okay, we're on Morningstar. Get this out of the way. Okay, so in the analysis on Perdoceo that you see over here, or not that you see the Morningstar screen over here. In the first analysis, again, you can find this link in the description below for free. We found that Perdoceo looked like a fantastic stock. Had high margins, and frankly, rapidly improving margins, and it was, if I remember right, undervalued or reasonably fairly valued. It was massively undervalued. So we'll get to all of this in more detail, and again, to watch the full first video, that context is below. But let's get to today's analysis. This is, again, stage 1 is the first video that we did on Perdoceo of my analysis process. This is stage 2, where we do the actual full worksheet. And you can get this full worksheet that you see on the right of your screen as part of the 5 free gifts, which you can also get in the description below as well. Okay, I have not updated anything on this sheet below here. If you're listening on the podcast, again, on these kind of videos, these stage 2 analysis, it's better if you watch on YouTube. So make sure you go to YouTube if you want to see the visuals, because a lot of this is very visual when we get to the numbers. However, if you want to stick on the podcast, I will say all the numbers, or I'll try to remember to say all the numbers and go through things that way as well. Okay, $738 million market cap. Does not pay a dividend. Operating income, okay, so 27.6 in the trailing 12-month period. The 5-year average is 1, 2, 3, 4. Go back to 2016. So 0.1 plus 10.3 plus 17.8, 10 plus 27.8. So 15.3%. I look for anything above 10% on a consistent basis. So in the last 5 years, it surpassed this every year, or surpassed that every year. And its average is 15.3%, which is fantastic. Because its operating margin, its trailing 12-month operating margin, is so much higher than its 5-year average, I would want to figure out what is going to sustain over the long term going forward. Is it going to be the 27.6 operating margin? Is it going to be the 15.3? Is it going to be below that? Is it going to be somewhere in between those two numbers? I would want to figure that out. And we could figure that out by going through the actual annual reports, which we're not going to get to today. We will do that stage 3 analysis if this company still looks good after doing this stage of the analysis. But that is something I want to figure out. What's going on to lead to the massive increase in operating margin, and then B, what's going to kind of be the long-term trend. Share count 74. Share count has gone 74 million since 2011 to 71 million in the GM period. If you want to understand all of this terminology, check out some of our other videos. I'm not going to get into that today because this would take forever if I explain all these, or you can join our masterclass, which I'll tell you about at the end of this video. This is a decrease of, so 3 divided by 74, 4.1% in the last decade. Okay, this is important. We talk about share count quite a bit in a lot of the videos, frankly. Typically, you don't see smaller companies buying back stock, but that's exactly what they've done. This is typically a good thing, but it's absolutely optimal if the company's shares are undervalued. Why? Because of why this is important in the first place. If a company's, or over the long term, a company is valued based on the cash flows and profits it produces at a kind of macro level. On a very micro level, that means the company is valued based on the cash flows and the profits they produce on a per share basis. When you have the same or equal, or the equal or hopefully higher profits, but lower share count, that means the cash flows and profits per share go up, which means the per share value of the company goes up over the long term, which increases the entire value of the company. The inverse of this is also true when you issue shares. Typically, especially in smaller companies, and where there's massive dilution, can rapidly decrease the value of the company. In this case, though, it looks like it's to some degree probably helping a little bit, but it's not, frankly, a ton because it's only 4.1%. Okay, book value per share, 12.86 fell from 2011 to 8.776 per share in the trailing 12-month period. Minus 8.76 equals 4.1 divided by 12.86. So its book value per share has fallen pretty drastically in the last decade, about 31.9%. We need to figure out what's going on there. Yes, book value per share isn't as important as it used to be, especially for a education company. Book value matters more for hard asset companies. So we need to figure out, A, why this fell at all. B, we need to figure out, is this decreasing the underlying intrinsic value of the company? Because when book value per share falls, because book value per share is based on the balance sheet and total assets minus total liabilities in the leftover amount, if it's positive, it's called book value or shareholders' equity. When that goes up over time, or when book value per share goes up over time, it's usually a sign the company, the underlying intrinsic value of the company is going up. When it goes down, the inverse of that is true, means the underlying intrinsic value of the company is going down. So this is a bit confusing because Perdoceo, again, is an education company. So we'd want to, A, figure out, does this matter at all for the company, and what is going into this number? To this decrease at all? Was there impairments? Was there write-downs? Was there an asset sale? What happened? B, then after that, we'd have to decide what this means for the underlying intrinsic value of the company. We can figure that out more, again, in stage 3 of this analysis, but that's why it's important. Okay, ROIC, 20.5 rounded up in the trailing 12-month period. And minus 10.6 plus 16.3 plus 14.3 plus 21.9. Okay, 7.2. Oops, I'm struggling here. 7.2%. Again, massive difference between the 5-year average and the trailing 12-month ROIC. Just like with operating profit, we want to figure out which trend here is more likely. We also want to know, and I think I remember talking about this in the original video, is 2016, 2017, and then 2018, there's a massive improvement in operating profits and ROIC. I want to figure out why, or we would need to figure out why by going back and looking at its annual reports from that time. But again, that's part stage 3. That's actually stage 4 of my analysis, so we're a long ways away from that, but that is something to keep in mind. Okay, 22.8, round up on the ROE. Oops. So 5.7 minus 10.3 plus 16.9 plus 17.8 plus 25.2 by 5. This is 9.4 rounded up. The only reason ROE is on here is because when I see ROE is higher than ROIC, it automatically means the company has debt. In this case, it's not a huge difference, but it does mean the company has debt. If this was, say, in the trailing 12-month period, 50% ROE and their ROIC was 20.5%, that would mean the company has an enormous amount of debt. Why does this matter? Or why does that show? Because ROE is levered by debt, unlike ROIC, where debt is not included in the calculation. So this is the only reason ROE is in this entire picture, is for an illustration. Okay, 21.2. Okay, this gets to an average of 8.6%. Again, 5-year average is actually negative in 1 year, and then a huge, massive increase in 2018. Again, want to figure out what's going on there. And just like with ROIC and operating profits, we want to know what is going to continue. Is it going to be the 21.2%, 8.6%? Is it going to be something above, or something in between those, something above, something below? We want to kind of figure out what the company projects and what we think is going to happen with those. And that's, again, later in the analysis. On this number, I look for anything above 5%, so this surpasses my threshold. On all these, Perdoceo surpasses all of my threshold except for book value per share, which frankly, again, was interesting. We need to figure out what's going on there. But it surpasses all my thresholds so far, except, or actually, yeah, that's the only one, in terms of potentially doing the, or continuing the analysis, sorry. But that's why we have these down here. These are ultra important. And frankly, cash conversion cycle is on here. But again, I'm going to go back and look. For-profit education. I don't know why they have a cash conversion cycle. I don't know why they have a cash conversion cycle. Cash conversion cycle is usually for hard asset companies, how fast they can sell inventory, how fast they make or how fast they can turn cash into inventory, how fast they can sell that inventory, how fast they can turn that inventory into sales, and that entire cycle repeats. I don't know why they have a cash conversion cycle. So frankly, it doesn't make sense here for me. At this point is an A, not applicable, because again, frankly, I don't know why they have a cash conversion cycle at all. So the more important numbers for them down here are these ones, the EV to EBIT. And yes, on the valuation tab, EV to EBIT is calculated here. My number I always calculate my own number because I don't know what goes into their calculation, but I do know what goes into mine. So we're going to calculate 738, the cash convert, or not the cash converter cycle, the enterprise value, so we can get to the EBIT, or so we can do the EV to EBIT calculation. Again, it's usually always different. Not sure why, but this is why I always calculate my own numbers, because I know what goes into them. A ton of cash, 476.7. That is very interesting because their entire market cap is worth $738 million. They have cash of $476.7 million. That means about 2/3, off the top of my head, of their entire company is valued just based on their cash, which we'll continue to look at as this goes on. But that is very interesting. That offers a very large margin of safety, potentially, depending on the debt. Debt, 9.78. 9.78. 40.6. So a ton more cash than debt. Again, huge margin of safety there. I'm assuming they don't have any preferred stock. They do not. Minority interest. Again, I would assume they have no minority interest, but I do another check like that just in case, and I'll actually scroll as well just to see. And I don't see any. So that is the calculation. So 738 minus 476.7 plus 9.78 plus 40.6 equals 311.7 million USD. What does this mean? That their enterprise value is far lower than the market cap. This is one, in this case, gigantic sign that the company could be enormously undervalued. Why? Because the enterprise value measures, when I look at an investment, any investment, I look at it as if I'm going to own the entire company, even if it's a stock. I think as a total business owner, I want to know what the price is I would need to pay to acquire the company's assets, or to acquire the company. In this case, a proxy for that is enterprise value. How is that? Because when you acquire a company, you typically either don't take on the cash or you don't pay for it. It comes with the acquisition, so that's why you subtract it. You add debt because you'd have to pay those off typically in an acquisition, and this is how. And then the other factor in this is market cap, which is share price times number of shares. So this means in this number that value comes to $311.7 million, which is far lower than its market cap, and it's a gigantic sign the company might be enormously undervalued. Okay, that is very interesting. 311.7, and then their EBIT, excuse me, was 193. That's going to show up as massively undervalued. Free cash flow was 148. Again, going to show up as massively undervalued. But let's keep going. 300.7 divided by 193 equals 1.62. So my number is actually lower than Morningstar's number. And this is 2.11. These, frankly, are two of the lowest enterprise value to EBITs and enterprise value to free cash flows I've ever seen. This is after evaluating thousands, tens of thousands of stocks at this point. These are two of the lowest I've ever seen. Ever. And I'll show you how powerful this is in a second. But before we go to the earnings yield, which will illustrate that, I look for anything below 8 on these numbers to consider the company undervalued. So these are way under that. And that is illustrated here with the earnings yields. 193 divided by 311.7 equals, I'm going to redo that because that's a large number that I think is correct, but never see that. Okay, it is correct. 9%. 48 divided by 47.5%. These numbers here, these earnings yields, they're the inverse of the numbers we just did above. And this shows you, based on today's numbers, what you should expect to earn owning this stock in the next year if you were to buy it today, based on today's information. Does this ever work out in actuality? No. But what I look for here is for a margin of safety is anything above 10%. So 61.9% and 47.5%. These show enormous margin of safety here, including or especially because of the things above that we talked about in the first analysis and just finished out in this analysis, with the company's margins growing at a fantastic rate. All that. This is frankly spectacular. I'm trying to put this into context, and I'm struggling to do so because I don't remember the last time I saw a number of these highs or these low for the valuations, EV to EBIT, EV to free cash flow, and this high for the earnings yields. It's been a really very, very, very long time, as in years, long time since I've seen this. And off the top of my head, the EV to EBIT and EV to free cash flow are some of the highest I've ever seen. So what does this mean here? This means that this company we need to do further research on because it meets all of my thresholds, or most of my thresholds up here, and it's enormously undervalued based on these two metrics. These are two signs, actually three, including the actual EV calculation, 3 signs that the company is enormously undervalued. So there's potentially huge margin of safety in the valuation, huge margin of safety in the amount of cash the company has, decent margin of safety in terms of their profitability and margin and stuff. So what we're going to keep doing here, which we haven't done in another video yet because we haven't seen this. We've seen some companies that were kind of close, and we've kept doing research on them, but we've never actually done the notes section down here before because, frankly, this is so spectacular. I think we need to do this. Where are we at here? Okay, financial health. So cash makes up 60.6% of their balance sheet. Short-term debt makes up, I don't know what it is. I'm not going to calculate this right now. Short-term debt makes up, I think it was something like less than 1%. And this was like less than 1%. I think it was like $40 million. So I'll just put less than 1% because it doesn't even show up here on this thing. I'll finish this up. Give it an enormous margin of safety. Okay. So what I'm doing in these notes section is, again, I save all these analysis that I do, so I can go back and look at any time I want to, whether I bought the stock or not, what I was looking at when I made the decision to buy or not, and I don't have to guess. So the reason I have cash and cash equivalents and short-term debt and long-term debt on here is to illustrate margin of safety or lack of margin of safety. In this case, it adds a gigantic margin of safety, which I added to the notes here. We've never done this in the video. We're going to calculate ROIC, return on invested capital. Again, Morningstar's information shows this, but I don't know what goes into Morningstar's calculation. My calculation on this number is always different because, again, I know what goes into my number, which you can see right here. It's ROIC equals EBIT, which is also known as operating profit, divided by, in parentheses, shareholders' equity plus debt and debt equivalents minus cash and cash equivalents and other investments. I know what goes into this, so I can use this as an apples-to-apples comparison to every stock I look at. This is another way to compare stocks to one another after you build a portfolio as well. Okay, 193. Shareholders' equity, go back to the balance sheet. Shareholders' equity is at the bottom, 613.6. That is a massive number. That's actually, what that means here, and again, this is why I do these calculations, because it doesn't just show you the actual number. It illustrates important things to you. What this shows is that this company's book value at $613.6 million is almost equal to its entire market cap. That frankly almost never happens anymore, especially for a company that doesn't rely on hard assets. So this is another sign that the company is potentially undervalued massively. Okay, plus blank in short-term debt, which was 9.78. I think the long-term debt was 40.5. 40.57 minus cash of 476.7. So what this shows is 6 plus 9.78 plus 40.57 minus 476.7 equals, wow, then we're going to get a number that you very, very rarely see, 0.25. 193 divided by 187.25. So this is 103.1%. That is my ROIC calculation. Again, I don't know what goes into Morningstar's number. This is the same calculation I use on every time I've analyzed a stock for years. You pretty much never, I can think of a handful of times, I've seen an ROIC based on my calculation that's been above 100%. When you see this, you need to double check your calculation to make sure you did it right, which is why it took me a little bit extra time to do that, because I was making sure I did everything right. B, it could mean the company has enormous competitive advantages, and that these competitive advantages are hidden because, again, most people just look at the ROIC number on Morningstar and they take that for what it's worth. But if you calculate this number yourself and the ROIC is really 103.1%, that is something, A, that a lot of people won't know, and again, it means the company could have massive competitive advantages. So what we're going to do here, again, something else we haven't done, is a basic valuation. We've already done several valuations. EV to EBIT, EV to free cash flow are relative valuations. Enterprise value is a basic valuation, and we're going to do another one over here as well. So 193. Oops. Times 8. EBIT times 8. Why the multiple of 8? I found that is usually the best estimate in terms of being conservative when it comes to the multiple on this. Sometimes if the company has huge competitive advantages, I do 11 times EBIT. If it has gigantic long-term competitive advantages, sometimes I do 14. But that typically, I found 8 is typically, or is a pretty good number here, conservative number here to do that. So 476.7 minus short-term debt, 9.78. 78, there we go. Minus 40.57 equals 1.970.4 billion dollars. Okay. What this means is that it's undervalued by XYZ because its current market cap is only 738 million, while I find a value of 1.970.4 billion. Okay, so to find out that 1.970.4 minus 738 divided by 4 divided by 1.970.4. So this company is undervalued by about 62.5%. That is enormous. Potential undervaluation. The reason I keep saying potential with all this is because until all of this is super important, But frankly, until we start digging into the financial statements, the 10Ks, 10Qs, proxies, yes, this is important, but that's where you find the massive red flags. Yes, you can find red flags doing this, but we want to find out potential red flag here with the book value per share falling, potential red flag cash and burn cycle. Again, I don't know why that's even on Morningstar at all. I want to figure out what's going on there. We also want to figure out the massive increase from, 2017 to 2018. What happened? Was there an asset sale? Was there a change of management? What happened? Why are their numbers so much better after 2017, starting in 2018? And will that continue? We need to figure those things out. And you can add those things here. Things to look at in annual reports. Book value per share falling over time due to impairments or asset sales. Two, what was the other one? Cash conversion cycle. Why is that a thing for this company at all? What happened with the massive improvement in the company from 2017 to 2018? Was there an asset sale, new management, acquisition? What happened? Okay. This, again, is the real world analysis of what I would do if I found a stock that was this massively undervalued. I would start evaluating this stock immediately because of how massively undervalued it is. We are going to do that. I don't know when we are going to put this on the calendar, but we are going to put this on the calendar to do sooner rather than later because it is so massively undervalued. But again, this is still only through stage 2 of my analysis process. We have to read the annual report, most recent annual report, most recent proxy report, most recent quarterly report. And then if it's still, we don't see any massive red flags there, then it's reading 5+ years of annual reports. Then it's looking for things like news on Google, blah, 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 blah. Then it's doing the full actual evaluations. We did a few here, but these aren't all of them. There's still a lot to go in this analysis, but as of right now, this company is massively undervalued. Massive margin of safety with its cash levels. Frankly, that's bringing some concern to me. Normally, in kind of quote-unquote normal times, this would bring me some excitement. With the stock market going straight up, this is bringing me some concern, frankly, because I've seen this before. And again, I'm not saying that this company is doing this, but I've seen this kind of stuff before when markets are going straight up. And it usually, again, in my experience, means something kind of funny is going on in the annual reports, which is why they're so important to read. But we will get to that when we get to that in the next video on Perdoceo. But for now, again, looks like a great potential investment, but still lots of work to do. If I missed something, if I should explain something better, if I didn't explain something well enough, let me know in the comments below. If you want me to look at a stock like this for you, let me know in the comments below. Again, this is stage 2 of the analysis. If you want me to look at a stock like this for stage 1 analysis to do a stock analysis video on, let me know in the comments below, as long as it meets 3 criteria. It's not a bank because I don't know evaluate banks. It's not an insurance company because you have to dig into the annual reports to evaluate them. And it also has to be producing revenue. Why does it have to be producing revenue? Because I did some analysis videos on companies that were producing revenue, and it was frankly quite boring. Because at the stage 1 and 2 of my analysis, I don't care about what the company does. I don't care about what the CEO says it's going to do. I don't care if there's speculation that it's going to change the world. I don't care about any of that until far later. If it meets those 3 criteria, let me know and I'll look at a stock anywhere in the world for you. I am giving preference to masterclass students, but I don't see anything on the calendar over on the other screen for masterclass students right now. So if you want me to look at a stock anywhere in the world for you, let me know in the comments below. If you're listening on YouTube, thanks so much. Really appreciate it. Make sure to like, love, share, subscribe, comment. And if you do subscribe, make sure to hit the notification bell so you're notified every time we release a new video, and release new videos all the time, including going live like we're doing later today as of this recording on the 22nd of September. We're going live later today to get a notification when we go live too. If you're listening on the podcast, again, we'd really appreciate all that same stuff. But on the podcast, we'd also really appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking for more specific help on how to become a better investor faster, make sure to check out our 5 free resources, or make sure to check out our 5 free gifts below, which part of those 5 free gifts is this worksheet we just went through. You can get this entire worksheet so you can analyze stocks better and faster with this worksheet. That's part of the 5 free gifts below. You can also get a free PDF copy of my book, How to Value Invest, and you can also get a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those at the links below in the description for this. And I recommend you take advantage of them because they're great resources. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our newly relaunched masterclass. We're giving away $9,000 in free bonuses, including what we call the Value Investing Blueprint, which is my exact step-by-step process. Not just the first 2 processes we went through in the Perdoceo video, but exact processes with videos, screenshots. I think there's 28 video resources, exact links where I look to find stocks, all that. We're also giving away free live training one-on-one training sessions with me as part of this, but just those gifts are only available to the first 10 people that sign up. So if you want to sign up, make sure to do so at the link below. But until next time, have a great day. Talk soon.